You know what's funny? The hardest wealth milestone isn't getting to your first million. It's not even getting to 5 million. It's figuring out what to do with it once you get there. Because here's the secret no one tells you when you're grinding your way up. Having money and having freedom are two completely different things. I've met people worth 8 figures who are still chained to their desk, and I've met people worth 2 million who haven't worked in years. So what's the difference? It's not luck, it's not inheritance, it's understanding how to make your money work harder than you ever did. Today, I'm breaking down the top 3 passive income strategies that actually move the needle when you're playing at the high net worth level. We're talking 2 to 5 million in net worth and beyond. And no, we're not talking about rental properties you manage yourself or starting a drop shipping side hustle. We're talking about wealth building strategies that the everyday millionaire actually uses. But here's the catch. Each of these strategies has serious pros, serious cons, and they're definitely not for everyone. So let's dive into who they're for, what you need to know, and what you should be thinking about before you make any of these moves. Let's get into it. Let's start with strategy number 1, dividend growth investing. Now I know you're thinking, dividends? That's it? That's your big strategy? But hear me out, because there's dividend investing and there's dividend investing done right at your wealth level. Dividend growth investing is about building a portfolio of established companies that not only pay dividends, but they consistently increase their dividends over time. We're talking about companies with decades-long track records of rewarding shareholders. The focus isn't on chasing highest yield today, it's about finding quality companies whose dividends compound over time. This strategy is ideal for high net worth individuals who want predictable cash flow without having to actively manage anything. If you're someone who loves liquidity, meaning you can access your money whenever you need it, this is huge. It's also perfect if you're in peak earning years and won't need the income immediately, because the real magic happens over 10 to 20 years of those dividends compounding. This is not for you if you need maximum income right now, or if you're the type of person who panics when the market drops 20%, because spoiler alert, it will. Now let's talk about the pros. First, it's truly passive. Once you build a portfolio, you're done. You're not taking phone calls, you're not managing people, you're not dealing with broken toilets at the rental properties. The dividends just show up in your account. Second, it's liquid. Unlike real estate or private business, you can sell these positions in seconds if you need the cash. The flexibility is valuable when you're at this wealth level. Third, it's scalable. Whether you're investing $500,000 or $5 million, this strategy works the same way. And fourth, there's historical predictability. We have decades of data showing how dividend growth stocks perform over time. So what are the cons? Here's where people get tripped up. Returns are generally lower than other strategies we'll discuss. You're probably looking at 8 to 12% total returns over the long term. That's solid, but it may not be that exciting. Market volatility is real. Your principal may fluctuate, and you will need the emotional fortitude to watch your portfolio drop 30% and not panic sell. Tax efficiency can be an issue too. Qualified dividends are taxed more favorably than ordinary income, but you're still annually taxed on those dividends whether you need the cash or not. And here's the big one. Dividend cuts happen. Companies that pay dividends for 40 years can suddenly cut them when times get tough. So diversification is critical. Before going down this path, ask yourself, do I have the time horizon? This isn't a get rich quick strategy. It's a get financially free in 15-year strategy. Do you understand the difference between yield and dividend growth? This is crucial. A 7% yield might look sexy, but if the company is struggling and about to cut the dividend, you're going to lose money. Are you comfortable with market volatility? If a 30% drop in your portfolio value is going to keep you up at night, this might not be your play. And finally, is liquidity important to you? If locking up your money for a year sounds terrible, dividend investing gives you flexibility that other strategies don't. Dividend growth investing is the boring but reliable strategy. It won't make you rich overnight, but it can absolutely generate meaningful passive income if you're patient and strategic about it. Strategy number 2, private real estate investing. And before you roll your eyes and think everyone talks about real estate, let me clarify one thing. I'm not talking about buying a duplex and becoming a landlord. We're talking about private real estate investing at a level that actually makes sense for high net worth individuals. So what is private real estate investing? Private real estate investing means putting your capital into real estate deals where you're a passive investor, not an active operator. This could be commercial syndications, private REITs, real estate funds, or debt investments like private mortgages. You're essentially partnering with experienced operators who find the deals, manage the properties, and handle all the day-to-day operations. You provide capital, they provide expertise. So who is this for? This strategy is for high net worth individuals who want higher potential returns than the stock market with some level of tangible asset backing. It's ideal if you're an accredited investor, which most people at this wealth level are, because that opens up opportunities not available to the general public. This works best for people who don't need immediate liquidity. Most private real estate investments lock up your capital for 3 to 7 years. If you're the type who needs to access your money at a moment's notice, this isn't your play. It's also for people who understand that real estate isn't just about appreciation, it's about cash flow, tax benefits, and diversification away from the stock market. This is not for you if you want to be completely hands-off with zero due diligence. You need to vet the sponsors, understand markets, and review deals carefully. Now the pros. Let's talk about why people love this strategy. First, the return potential is typically higher than public markets. We're talking potential annualized returns in the 12 to 20% range, depending on the deal structure and risk level. Second, the tax advantages are incredible. We're talking about depreciation benefits, potential 1031 exchanges, and opportunity zone benefits in some cases. Real estate is one of the most tax advantaged asset classes that exists. Third, you get diversification. Your wealth isn't 100% correlated to whether the stock market goes up or the stock market goes down. Real estate often zigs when stocks zag. Fourth, there's the inflation hedge. Real estate values and rents tend to increase with inflation, which protects your purchasing power. And finally, it's still passive. You're not managing tenants or fixing toilets. Professional operators handle everything. What about the cons? Well, here's the reality check. Illiquidity is real. Your money is locked up for years in most cases. There's no sell button like with stocks. If you need that capital back early, you're often out of luck or taking a massive haircut. Operator risk is huge. You're trusting someone else to execute the business plan. Pick the wrong sponsor and you could lose everything. This isn't theoretical, it happens. There's less transparency than public markets. You're getting quarterly reports, not real-time data. Some people find that uncomfortable. Minimum investments are often high, $25,000 to $50,000, sometimes $100,000 per deal. And to be properly diversified in real estate, you probably need to be in multiple deals. And here's one people don't talk about enough. The risk isn't zero. Real estate markets can crash. Tenants can default. Construction can go over budget. The returns aren't guaranteed. So before you jump in, ask yourself these questions. Can you afford to have your capital locked up for 5+ years? If not, don't do the deal. Do you understand how to vet sponsors and operators? This is arguably the most important skill. The deal matters less than the operator executing it. You need to look at track records, talk to previous investors, understand their investment thesis. Are you comfortable with the lack of liquidity? There's no panic selling in private real estate. You're in it for the duration. Do you understand the specific market and asset class? Multifamily in Austin is different from self-storage in Iowa. Industrial in the Midwest is different from retail in Florida. You need to understand what you're investing in. And finally, what's your risk tolerance? Some deals are stabilized and conservative. Others are ground up development or heavy value add plays. Know what you're getting into. Private real estate can be an incredible wealth building tool for high net worth individuals, but it requires due diligence, patience, and the ability to lock up your capital for years at a time. It's not for everyone, but for the right person, it can be a game changer. And now strategy number 3, the one that most people never even consider, private business equity. This is a strategy that separates people who are wealthy from people who are building generational wealth. And it's probably the most misunderstood passive income strategy out there. Private business equity means owning a piece of an existing operating business where you're not involved in the day-to-day operations. You're not starting a business from scratch. That's active income with extra steps and massive risk. Instead, you're becoming a silent partner or a minority owner in businesses that are already profitable and established. This could be a local service business like a manufacturing company, an e-commerce brand, a medical practice, a distribution company, really any profitable business where the owner needs capital for growth, wants to de-risk or look at a strategic partner. This strategy is for sophisticated investors who understand business fundamentals and can evaluate opportunities critically. You need to be comfortable reading financial statements, understanding business models, and assessing whether an operator is trustworthy and competent. It's ideal for people who have significant capital to deploy. We're typically talking $100,000 to $1 million per deal, and you can afford to have the capital locked up for the long term. These aren't liquid investments. This is for people who want potentially asymmetric returns. We're talking about the possibility of 20 to 50% annual returns if you pick the right business compared to 8 to 12 in public markets. This is not for you if you need liquidity, if you can't evaluate business risk, or if you're not comfortable with the fact that you could lose 100% of your investments if the business fails. Let's talk about why this strategy can be so powerful. First, the return potential is significantly higher than almost any other passive income strategy. A well-chosen business investment can generate 20 to 40% annual returns or more. Second, you have negotiating power. Unlike buying stocks where you're a price taker, you can structure these deals. You can negotiate preferred returns, liquidation preferences, exit terms, board seats. Everything is on the table. Third, the tax advantages can be incredible. You can benefit from qualified business income deduction, bonus depreciation on equipment, and potential capital gains treatments on exit. The tax code rewards business ownership. Fourth, you get real diversification. Your wealth isn't tied to whether tech stocks go up or down. You're owning real cash flowing businesses in various industries. And fifth, and this is underrated, you can add genuine value. With your capital, your network, or your experience, you can help the business grow, which directly increases your returns. Now for the reality check, because this strategy has serious downsides. Illiquidity is extreme. You can't just sell your stake in a private business like you can with a stock. Your capital is locked up for years, sometimes a decade or more. There's typically no exit until the business sells or the owner buys you out. Due diligence is intensive. You need to really understand the business, the market, the competition, the operator, the financials, the legal structure, everything. This isn't something you can do in an afternoon. Operator dependency is huge. The business's success is entirely dependent on the owner-operator executing. If they make bad decisions, get sick, or lose motivation, your investment suffers. There's concentration risk. Unlike owning 50 dividend stocks, you might have 200,000 in one business. If that business fails, that's a significant loss. And finding deal flow is hard. These opportunities just don't show up on E-Trade. You need to network, build relationships, and often spend years cultivating these opportunities before they materialize. Before you even think about private business equity, ask yourself these questions. Do you have the expertise to evaluate businesses? Can you read a P&L and balance sheet? Do you understand unit economics, customer acquisition costs, margins, and competitive moats? If not, you're going to get taken advantage of. Can you afford to lose the entire investment? This isn't diversified. This is concentrated risk. You need to only invest capital you can afford to lose completely. Do you have deal flow? Where are these opportunities going to come from? Your network, industry connections? You can't invest in what you can't find. Can you evaluate operators? This might be the most important question. The business matters, but the operator matters more. Do you know how to assess whether someone is competent, trustworthy, and capable of executing over 5 to 10 years? What's your exit strategy? How do you get your money back? Is there a buyout clause, a sale timeline, or are you stuck hoping the operator wants to buy you out someday? And finally, are you prepared for the long haul? This isn't a 2-year plan. This is often a 5 to 10-year commitment. Private business equity can generate life-changing returns for high net worth individuals who know what they're doing. But it requires expertise, patience, risk tolerance, and the ability to source and evaluate opportunities that most people never even see. So we covered 3 powerful passive income strategies: dividend growth investing, private real estate, and private business equity. Now the question is, how do you think about this? Here's what matters most. There's no perfect allocation that works for everyone. What works for you depends entirely on your specific situation. Think about your liquidity needs. How much of your net worth do you need to access quickly? If you might need capital in the next 1 to 2 years, that money needs to stay liquid. Dividend stocks give you that flexibility. Real estate and private businesses, not so much. Think about your time horizon. If you're 35 and building wealth for the next 30 years, you can afford to be patient with illiquid investments. If you're 60 and transitioning to retirement, you might need more current income and less locked up. Think about your expertise. Be honest with yourself. Can you evaluate a business? Do you understand real estate markets? Or are you most comfortable with public market investments? Invest in what you understand, not what sounds exciting. Think about your risk tolerance. These strategies have different risk profiles. Dividend growth stocks are relatively low risk with lower returns. Private business equity is high risk with potentially massive returns. Know what you can stomach. Think about diversification. The goal isn't to pick one strategy and go all in. It's to build a portfolio that balances liquidity with return potential and risk with reward. Some capital in liquid dividend stocks, some in real estate for tax benefits and diversification, maybe some in private business if you have the expertise and risk tolerance. Start small and scale. Here's my advice. Don't go all in one day. The key is to think strategically about how these pieces fit together for your specific situation. What works for someone else might be terrible for you, and vice versa. Here's the reality. Building passive income at the high net worth level isn't about following someone else's formula. It's about understanding your options, knowing the trade-offs, and making strategic decisions that align with your goals, risk tolerance, and your life situation. Dividend growth investing gives you liquidity and simplicity but low returns. Private real estate gives you tax benefits and higher yield but locks up your capital. Private business equity can generate exceptional returns but requires expertise and comes with real risk. None of these strategies are perfect. All of them have trade-offs. The question isn't which one is best. The question is, how do any of these fit within my overall financial plan? Am I in the right season of life for this? Maybe you're in your peak earning years and can afford to lock up your capital for decades. Or maybe you're approaching retirement and need liquidity. Maybe you've spent 20 years building businesses and can evaluate opportunities others can't see. Or maybe you're still learning and need to start something simpler. The difference between staying at your current wealth level and actually building financial freedom comes down to education, strategy, and honest self-assessment about where you are and where you're going. If you found this valuable, hit the subscribe button, drop a comment, and let me know which of these 3 strategies you're most interested in. Stay informed, stay empowered, stay successful. I see you in the next one.